If you could no longer afford your policy, what would you do?
You don't have to sell your life insurance policy, but you should know what it's worth.
This is an asset. It's like your house. Your house could be an asset. Some people say it's a liability, but it's something you can sell. It's something you can transfer. And if you can't afford it anymore, you just need to come up with the best way to exit. And that could be a life settlement. That could be selling it to someone else. That could be, using dividends to pay your premium. So to me, it's just having options.
What's going on, everybody? Welcome back. Another week, another wealth webinar. We are here, definitely here to teach you one thing and one thing only, and that is how to teach you to take back control of your money. But with teaching you how to take back control of your money, it's vital that you learn banking. It's vital that you learn how to take back the banking functions in your life. It was kind of funny in WTF, we were talking about, how the current administration is shutting down the Department of Education. We got talking a little bit about education, and it made me think, how many of us in school or college learned how to balance a checkbook? How many of us learned anything about retirement plans or planning for retirement or saving or just anything at all about how money works? Because we didn't really learn anything about that. At least in my generation, I don't remember learning at all about that. I remember business math, that was mathematics. So it's interesting when you really think about, the current state of affairs when it comes to money. A lot of people just don't understand it, but it's not their fault. It's the fault of the system. It's the fault that we were never taught how money works. So really, with 118 people in climbing, I realize that every single week, 6 times a week, we do live webinars to teach you the truth about money. The difficult part about teaching the truth about money is you get a lot of pushback. You get a lot of people that don't want the truth because the truth hurts. It really does. And a lot of the things that we talk about are completely unconventional. It's coloring outside the line. I literally love to tell the team every time I talk to them, I'm like, everything we do is coloring outside the lines. And that definitely comes with controversy. That comes with people pushing back. And one of the things we're going to talk about today is we're going to go deep into these policies that we're always talking about. We're not going to just talk about whole life, but I'm going to make it a premise to focus on whole life insurance, but specifically designed or specially designed and engineered whole life to be exact, because that is what we do. We don't sell life insurance here at Money School or the Money Multiplier. What we do is we solve problems, and we do that using an unconventional vehicle called a whole life policy, but designed and engineered for a specific need and goal. And one thing I can tell every single person watching this is there is no one policy that's the same. Literally, it's kind of like finding a snowflake that's the same. There is no one snowflake that's the same. So the same thing when we design these policies for any of our clients, and we've done this for tens of thousands of people, when we do this, every design is custom tailored for that client's needs and goals. The clients tell us what it is they want. What are they trying to do? What is the problem they're trying to solve? We design the policy around that. But as time goes by, I've witnessed this now, having done this for over 10 years now, I've seen a unique thing happen. People will watch the 90-minute video that many of you have already seen. People will come on to Take Back Control Tuesday and see one of our presentations, or maybe just Wealth Webinar, and they'll be really jonesed up. They'll be like, yeah, I want to take back control of my money. I want to take back control of the banking functions. I don't want to leak money to the banks. I don't want the banks to use my money to make 400 to 1,300%. I want to own that, and I want to learn how. And then they get started. And we design the policy to fill their needs and goals. We get them started. We implement it. We have a whole team that helps them implement. But here's a funny thing that happens, and not for a lot of people, but for some reason, our minds do weird things. Because of our whole life, we've been taught money works one way. And then all of a sudden now, this is that crossroads. You get to this point, and now we show you that money works actually a completely different way. The way that the wealthy have always done it, the way that we've never been shown money works. And you make this switch, which is a mindset shift. And when you make this shift, you're all in, but then all of a sudden, you sort of step back a little bit. You drift away from it. Your friends, your family, your coworkers, all the people that surround you start getting in your ear and being like, wait, you're putting money into a whole life? That's the stupidest thing I've ever heard in my entire life. Why would you ever do that? And you start questioning it. You start thinking, why am I doing that? You go back in, you look at your statement, you're doing the math all wrong. I just had this happen with a client. He's looking at it and he's like, why am I doing this? This makes no sense. I'm putting money in and I'm just losing money. He was looking at the wrong columns, but no problem. So anyway, they start getting all these ideas and then their mind starts going, and what do? They're like, I'm not going to do this anymore. And they shut down. We try to call them. We reach out to them to say, hey, what's going on? How come you're looking to surrender? Why is this policy lapsing? This is a golden goose, literally. Like your policy is a golden goose, and you're just looking to just throw it away. Now, every once in a while, we get a client that gets on the phone with us and says, yeah, maybe I'm missing something. Can you walk me through this? Can you explain this? Like, what am I missing? And we start going into the numbers. We explain, okay, it's not just about the policy, it's about the process called the infinite banking concept. What was it we initially started doing? Great, did you do that? Yes, I did, but then I stopped doing this. Okay, well, that's one leak, but then we go into the numbers, and every time a client gets on a phone with us that allows us to recorrect them, they start to see the light again. So really what happens during that period where we're so ready to make a change, so ready to take back control, that then all of a sudden people get in our ear and we start to conform with the old ways. The things we've been taught our whole life, the money that, goes to the bank. Oh, well, maybe I should just be putting it in the bank. Or maybe I should just be putting it in a 401k. And why am I not buying NVIDIA? Why am I not buying the S&P 500? Everybody says it's going to the moon. And then they surrender their policy. This is a tragic day. It's a tragic day because if they only knew what they were giving up, if they only knew how valuable that policy was, they would never get rid of it in a million years. They would literally fight, kicking and screaming to let go of that policy. They would do anything, work extra hours, do overtime, go to friends, borrow money to keep that thing alive if they knew what they had. I'm going to give one story and then I'm going to introduce our speaker, because this is the speaker today. Okay, Rob, he works for a company that fully understands how valuable these policies are. You see, we'll go to stocks. In stocks, when everything starts falling apart, when NVIDIA loses 17% in a day, people start getting fear. They start forgetting why they bought NVIDIA, and they get freaked out and they sell it. But when they're selling, somebody's buying because somebody sees the value that the other person doesn't. The same is exactly true in the insurance industry. When somebody's surrendering or wanting to get rid of their policy, the insurance company will always take it back, because why wouldn't they? If they got a policy that they issue, especially a whole life insurance policy, which the insurance company bears the weight of the risk, okay, they are guaranteeing to pay a death benefit someday when you die. But not only that, they're guaranteeing you a guaranteed interest rate. They're paying you dividends, although not guaranteed. They're giving you all these things. So if you say, I don't want it anymore, they're glad to take it back and pay you the remaining surrender value in the policy, because then they're off the hook. There's zero risk for them. They win. And who loses? The policyholder that gave it up. But you see, there's this whole other world, this whole other side of folks like Rob and his company that understand what these policies are, understand the value, and are willing to buy these policies from people that want to get rid of them. And it's a shame. And people like Rob will try to talk you out of it because he knows how valuable it is. It's like, there's a book called 3 Feet from Gold. Greg Reed wrote the book. Read it if you have not read it. In that book, it talks about a gold miner. Okay, he gave up everything because he was going to strike gold, and he had a map that showed him exactly where the gold was. For days and weeks and months and years, he's digging for gold, not hitting it, and he's buying all the supplies. And there's this little boy who carried around a wheelbarrow that sold supplies like picks and axes and shovels. And one day, this gold miner who has not struck gold just kind of had just said, I'm done. He gave up. I'm done. I don't want to do this anymore. Well, the little boy with the shovels just happened to be there, and the gold digger says, hey, here, how much will you give me for this gold mine right here? And the boy says, all I have is whatever, we'll call it $10. And the gold miner takes it and runs away. And the little boy grabs a shovel and starts digging. 3 feet the other direction, the little boy digs, and he strikes gold. He hits the largest gold deposit ever hit in that time. There's truth to this story. Read the book. I think it's based on true facts. That gold miner was 3 feet from gold, but he just couldn't see it. He couldn't make it. Well, Rob sees that everybody's 3 feet from gold when they've got a policy. It's just, do they realize how close they are? And that's really the question. I had a client that had an unbelievable policy, a policy I designed many, many years ago before 7702. Somebody got in his ear about an IUL. And I ran all the math. I spent extensive amounts of time running the math on his policy, showing him, here's what it is. You're printing money. You struck gold. Like every dollar you put in, you're taking out more than you actually put in. But he went the other direction. He replaced that golden whole life policy that you can no longer get anymore. They don't make those ones anymore. It's pre-7702. And he went to an IUL, and he did it because of hope and hypotheticals. Because the illustration showed he was going to make more than he would on the illustration with the whole life. So he went that direction. I've not talked to him since, but that was a hard day for me. And what I hope to do today, and what I hope to be able to introduce you all to, is an option. An option. Some folks will come to that point where something happens. They lose their job. You just watch that 2025. Listen, we are staring down the barrel of a recession. And if we hit a recession, guess what happens? Unemployment numbers go up. And that means some folks lose their jobs. They don't make as much money. They're going to hit hard times. They just can't make ends meet. And when that comes, they got this golden goose, this policy that maybe they're going to have to make and figure out, what do I do with this? I can't maintain it. Do I surrender it to the insurance company? Do I reduce my PUA deposits? Do I do this? Do I do that? Or now we're just going to add another arrow to the quiver. Do you call Rob? So let me introduce Rob. Actually, Stephen, because you made the introduction, how about I let you introduce Rob? And then I'm just going to go through and I'm just going to kind of walk through some questions that we wrote down for Rob. And then I'm going to have every one of you, I'm going to open it up and every one of you can ask questions, because this question comes across many people's minds. What if? And that's what we're going to hit. Today is the what if. Go ahead, Stephen.
Yeah, awesome, man. It's going to be a really cool show today. You know, we always are out there, you know, in the marketplace and attending events and masterminds and always trying to learn about, you know, how can we share more value? How can we provide more services and options and ideas for our clients? So as they take control of their money and kind of go on this path of alternative investing, alternative ways of looking at money compared to the traditional, you know, financial advisor route. Well, what does that look like, you know, not only today and in a couple of years from now, but what does that look like down the road? What does that look like at retirement time? Maybe you're at retirement time now and you've had a policy your whole life for many years and you're wondering, like, how do I use this thing? And so we're always out there looking for new ways. And I ran across Rob and we hopped on the phone finally. We kind of went back and forth for a while and finally got connected on the phone. And it was just it was a mind-opening conversation for me. You know, I have been, you know, a financial advisor, you know, as a financial advisor, fully licensed securities and everything 15, 16 years ago. I've been in the, you know, financial education space ever since. Been doing, you know, infinite banking with, you know, specially designed whole life since 2020 now again. And so you know, I always tend to think that I know everything, but you know, what I've learned in business is once you stop learning, you start losing and failing. And so I always try and keep that open mind. So when I was talking with Rob, he was just blowing my mind with his knowledge. And Rob, I'm going to let you kind of introduce yourself, but you know, you mentioned you live down in South Florida, just a little south of me, I believe down in the Lauderdale area, but you've been in this business, I think you said over 30 years, and you and your business partners have been doing it all for that long. And just the things you were telling me on that quick conversation we had on the phone, I was like, we got to get this guy on Wealth Webinar. We got to get him to share his knowledge and what he knows about this with our campfire. And so, Rob, thank you for being here today. And I'm really excited to get into this with you today.
Well, I really appreciate it, Chris and Stephen. Like I said, like you kind of previously mentioned, I'm in the life settlement business. So I technically sell you life insurance, but I don't sell it to you initially. I sell it to you later. And what that means is somebody who has a life insurance policy, whether it be a whole life, very few people sell whole life in our business. I'll make that point right out of the gate. Universal life and all the many iterations of that, and term life insurance, when they no longer want it, no longer need it, or can no longer afford it, most people will either surrender the policy, as you alluded to, Chris, or they'll let it lapse. Just to give you a statistic, we've backed into the numbers to the ACL Life Fact Book because the insurance carriers will never let you see this number. But on average, every year, people over the age of 65 in the United States will lapse or surrender $112 billion of death benefit every year. like clockwork. Our industry will buy close to 5 billion. We've had years where it's been higher than that, but somewhere in that vicinity, that's on top of the 112. So when you talk about, does anybody know what a life settlement is? The fact that I'm on your show and I'm going to educate the people that are listening in on this, very few people do. They don't know what it is, and if they know a little bit about it, it's usually something that's drastically wrong with their understanding of it. So what we do is we offer people a free non-binding appraisal of their life insurance to take back to people like Stephen and Chris and Craig and say, okay, I can surrender it for this, I can keep paying the premium, it'll do that, or I can sell it and take that this amount of money today. We do numbers through our association, which I serve on the board, the Life Insurance Settlement Association. We look at the number of policies are bought in a calendar year, what the death benefit is, what the surrender value is, and of course what the settlement amount is. And in the 3 years previous, we're about to do our fourth, will land somewhere between 5.2 and 7.8 times more. So for example, you're going to surrender your policy for $100,000, you may be able to sell it for $780,000. So as a financial advisor, I look back to you guys and say, what would you rather have your client give you to work with for the future, 100,000 or 780,000? And the answer is pretty simple. So our problem, and that's the industry-wide problem, is we are not in front of enough people to talk to them about this option. Take a couple reasons why. Number one, it's expensive. There's ads running on TV right now from a group called Coventry and a group called Abacus. They run those ads, but most people have no idea that you can do this or even what it means. So our goal is, how do we educate people? How do we get the word out? Honestly, I'll be honest with you. I'm going to tell you this right now. This is a great format you're doing. This has been the most productive way for me to get the word out in the last 6 months, is to be on multiple podcasts, talking to different audiences about this option. Because quite frankly, the insurance companies work overtime to make sure you don't know about it. Stephen talked about, they do not want you to know you can do this. If you're a captive insurance agent, we'll just use one out loud, New York Life, you are prohibited from talking about this to your client. Not allowed. I view that as criminal. But they're bigger than us. If you remember back at the financial crisis of 2008, 2009, they handed out the TARP money. We all remember that. How many insurance companies got TARP money?
I don't think any.
None.
Zero.
They didn't need it. So if you got a business model of, if I write 100 policies, for every 100 policies I write, 90 of them will never go to claim. This is a pretty good business you've got going. So people buy the wrong stuff from the wrong people. Most of the people that come to me in a direct fashion, whether it's through the commercials or advertising on the internet, have no insurance agent. They're gone. They were sold a product that at the time might have been the best commission available, the best cruise, the best train ride through China, whatever it was. That was the reason they bought that policy and not the one they probably should have bought, because it was a better commission to the agent. So shows like yours that educate people about how you really understand what life insurance is and how valuable it could be. Keep in mind, you should keep the life insurance if you can afford it, if you bought the right policy. It's something we tell people all the time. We have a business that was born out of the medical business. So we started this in the early 90s. We like to joke and say before the turn of the century, but this business was predominantly geared towards people living with a terminal and or a chronic illness. And at that time, majority of it was HIV and AIDS. So people were dying, literally. And the average face amount was $60,000. And we were selling people's policies for, $10,000, $15,000, whatever it was. And they would take the money, they'd quickly go buy the meds that weren't readily available. And quite honestly, at the end of that run in 96, 97, those folks are alive today because the money they got from selling their policies were able to buy AZT and all those drugs before the protease inhibitors. So that's how it was born out of, because people looked at this and said, well, if you can help people that are terminally ill, what about people that are going to live a lot longer? So the 6-year LEs, 10-year LEs, there's their life expectancies, 15. Now we're looking at people that can sell people who are 60s and they're healthy. Who would buy that? Pension funds would buy that because they've got a long time horizon they have no liquidity needs around the corner. They like this asset to purchase because it's uncorrelated. If the market goes down, the life insurance death benefit does not, the premiums does not, and the life expectancy of the client that you purchased doesn't change. So they like that. So when I tell you they want more of this, They're sending different revenue streams to us to help educate people to get the word out. So that's my introduction. I'm sorry I talked too long, but that's kind of just to give you the feel of what I'm up against.
I think that's awesome. So I want to go back to that book, 3 Feet from Gold, that was written by Greg Reed. I love it. Samuel Allen came in. It's been a while, but Samuel Allen told me the name of that guy that book was written about is R. Darby. Fun
Life
fact,
insurance.
Darby made a fortune selling insurance. So Samuel, thank you so much for reminding me that. It's been a while since I've read Think and Grow Rich. I need to get back and read that. And Greg Reed, took that out of that book, Think and Grow Rich, with the permission of Napoleon Hill Foundation, and did 3 Feet from Gold. So just useless fact, but kind of a cool one because it just leads into this. Rob, thanks again for coming on. Like, one of the things that I'd like to know is, when you got into the insurance industry, did you get into the life settlement side, or were you selling life insurance and then moved over to that side?
No, I'm completely different. So, I mean, I tell this story all the time. So I was in commercial real estate. I graduated from Florida State, went into commercial real estate through my roommate's brother. And it wasn't a really good time to be in it in the early 90s, but I was hanging in there because I didn't have a lot of overhead. And I was at the gym, and a guy said to me, "Hey, you should come check this new business I'm in. I think you'd like it. I think you'd be good at this." And he tells me what it is, and it's going to sell policies for people that are dying from AIDS. More or less what he said to me at the gym, and I thought that might be the most ghoulish thing I've ever heard in my life. I mean, really, like, disgusting, right? I really had a bad taste in my mouth. I'm driving home, and it's at the stoplight. I mean, I remember the stoplight where it was in Fairbanks Avenue in Winter Park, Florida. And I say, "Wait a minute. No, we'd be keeping the insurance companies honest. They'd have to honor their pledge if somebody were to get money, putting life back into life insurance when they needed it the most, because they didn't need the insurance policy because they couldn't afford it. They needed the meds." So I stumbled into it. Okay. So at the time, we didn't really talk to insurance agents or financial planners probably until, 98, 99, because at this point in time, it was the HIV and/or AIDS / LGBTQ community that talked amongst themselves about this. So there's movies. Remember the Dallas Buyers Club?
Oh, of course.
Okay, well, there's a scene in there where Jared Leto hands money to Matthew McConaughey and literally says he sold his life insurance policy. And that was the reason he was able to pay him back, was he had a life insurance policy he could sell him. So that's how it began. Interestingly enough, there's a good friend of mine, Scott Page, is featured in a documentary the New Yorker picked up called Cashing Out. And it's about the beginning of the radical settlement industry, which is interesting for us because it really was the bridge to take us to where we are today. Keeping in mind, if you still are suffering from a terminal or chronic illness, you can absolutely sell your life insurance policy. And you guys will know this. The accelerated death benefit that many insurance companies now offer is a result of the radical settlement industry. That was their answer to it. Now, if you want to qualify for one of those, you are going to be very, 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 very sick. It's not going to be somebody that might be sick. They're going to be absolutely sick. So we tell people in that circumstance, do not sell your policy. Unfortunately, they don't have the capital to continue to make the premium payments. They need the capital to do something else. So that's how I got into it. I was never in the insurance business. Obviously, I'm insurance licensed now. We do some insurance business. We do some conversions. Policies need to be converted from term to a permanent product. But having said that, I was never in the insurance business. And I've learned a lot about the insurance business. In the beginning, I learned a lot of bad things about it. There's a lot of people take shortcuts and just kind of sell you the wrong stuff, which is why, unfortunately, my business took off, because there's just a lot of stuff out there that weren't performing. You guys remember the vanishing or disappearing premium?
Oh, yeah.
Give you?
Yeah.
Yeah. So that I used to kid people. I used to give seminars and speeches. I'd say, so they weren't lying. And everyone likes to think that premium, they lied to you. They didn't lie. The premium that was $18,000, in your mind, you thought maybe zero, but really they just meant $58,000. The 18 vanished. Now it's 58. And of course, they're not allowed to say those words anymore. So our goal is nothing but to say, you mentioned arrows and quivers, to put this in someone's mind as to what to look for, so you don't have a lapse that you didn't pay attention to. Most people receive lapse notifications, grace notifications. Those are warning signs, red flags, if you will, to be paying attention to your client's policies. Because what happens in the financial planning world is you take someone's life insurance policy, that they literally don't need. It's not performing well. It's not one of those whole lives you designed, Chris and Steven. It's a bad one. And they want to put them in something else. In many cases, that's an annuity. And in other cases, it's to help them age in place in their homes, to retrofit their house, to get ready for them, the ramps, et cetera, so they can stay in their house. And meanwhile, that asset that they paid for all those years, their home, they're not selling at a discount, at a fire sale. They're keeping it. And if you paid attention to the news of late, these homes are growing in value exponentially because people are always looking for a home that's wheelchair accessible, has one of those stair lifts, et cetera. One of those take the master bedroom and made an extension on the downstairs. This is what the money's being used for today for many people. Certainly not the high net worth. That's a different category.
I found it interesting when you first came on, and maybe some people caught this, maybe some didn't, but you had mentioned very few people sell their whole life policy. So one thing, Rob, that I can tell you, knowing what I know, is you're going to be very busy in the next decade. I don't know if you've heard of this product that was kind of created in the back labs of the insurance companies called an IUL, but those are gonna run into some problems in the later years, and I think that's going to be a really, really good avenue for you to buy those policies, because you talk about policies being sold wrong. I've been doing this 21 years. I've come up through the UL world, the Target Universal Life policies. I'm sure you guys buy a ton of those because those are
That's the
policies
most we
that were,
buy.
yeah, those are policies that were sold with like an interest rate that no longer exists. Back
Correct.
then, so they were sold. They looked great on paper, but then interest rates fell, and now the policies, like I went out to so many calls with clients. I was at New York Life at that time to tell them, hey, I know this Target Life policy you bought was supposed to have all this money, but unfortunately, your $100 premium you're making now, you now have to pay $300 a month just to keep it alive, and that's only going to get you to 80. And then after that, so we would replace them with whole life or find solutions. But we went from the Target ULs to VULs, because we now buy term invested difference was all the rage, and the insurance company's answers was, oh, well, we'll just give you term insurance within a sub account, an investment account, giddy up and go, it's all tax free. We sold tons of those, and then in 2008, the market, the Great Recession, blew the top off VULs. They were falling apart left, right, and center. Again, if you've been doing this since the 90s, great buying opportunity for you there. And now IULs. I think it is, to me, in 21 years, the product that is single-handedly, more than any other product, sold completely wrong, sold on false pretenses, and sold on hopes and promises that will never materialize because mathematically they just can't. I went down a long rabbit hole there, Rob. I'm sorry, but
No, that's the rabbit hole, because that's the thing, is they sell you these, and if you take say, what are the percentage chances? It's like less than 1. They might work, but you gave the snowflake example at the beginning. They're all different. Everybody's life's different. Everybody's finances are different. Sometimes they work and they don't work as good as they're supposed to, but at the end of the day, they actually work. But IULs, we've been warning people. Our industry has, certainly the investment community understands what's there. And the clients certainly can't afford them. They get to a point where they're just going to blow them up, and they just retreat. And like I said, wanted to mention earlier, they don't have any guidance. Their agent is gone. You can't talk to him. So, and the new rep, if you will, doesn't come in, doesn't really communicate, doesn't even know what they're even talking about. So we tell people, let's get you an offer, what that offer. The offer may be there is no offer. We may not be able to get you an offer. You might have, your premiums might be too expensive. It's just not going to work. But this at least check that box. You don't have to sell your life insurance policy, but you should know what it's worth. I mean, in 1911, I say, when did the life settlement business begin? It began in 1911 when Supreme Court Justice Oliver Wendell Holmes said that life insurance has all the real properties, all the real characteristics of real property. It's just like your home. You can make your neighbor the beneficiary. The next week, you can make the person you met at the grocery store the beneficiary. It's your policy. You can do with it as you please. But people don't know that. They have no idea it's theirs. CPAs are the best example. They'll say things like, my own CPA, that I tell him 100 times what I do for a living. He's like, well, that's an expense if you pay a premium payment. They don't list it as an asset. They don't list your life insurance as an asset. They think that's an expense. So that's just like your car insurance or your flood insurance. Down in Florida, we have about 75 insurances, right, Stephen? For everything we own. So that's the key, is it's education. Your show, the type of content. I mean, what you tell people is valuable. They don't get that every day. We're too busy on our phone, flipping and swapping and looking at something for 18 seconds. And the insurance industry relies on that when they give you a sales presentation. I had an agent when I first started speaking to agents around, I think it was 2002. He has a giant one of those ink press stamps, and it was in red. He would put in every illustration, and it said guaranteed in giant letters, and then underneath in small print that no number on this page will ever even remotely come close to any that takes place with respect to your life insurance policy. And he put that on every single policy he ever wrote for a better part of maybe 40 years. He's always doing it. And he said, because back to your snowflake, they're all different. They're all going to perform differently, and no two are the same. And that's what we try to preach to people. So the only thing I tell people is, there's information available. Don't believe everything you read, or at least I should start with maybe just read some things and try and get an understanding what it is you're interested in. But talk to your financial services advisor, your life insurance agent, your CPA, your accountant about options as it relates to your life insurance policy. And if it's something you want to look at too, my company's around. There's many members of LISA, the organization that I'm on the board of, as I mentioned. There's a lot of great companies in this business. And it's just unfrank, for every one person that knows about it, 99 do not.
Yeah. One thing I want to hit, because it's come up a few times, is some of the myths, the myths about the life settlement. I mean, even me, I started my career back in early 2000s at New York Life, and everything you said, we never could mention life settlement. The main goal was, if a client doesn't want to keep paying premium, let them surrender it back to the insurance company, because then the insurance company wins. And we were taught very well to do that. But one of the other things that is a misconception, or maybe not, maybe it's just the industry has changed. In the life settlement, when we think about it, we think life settlement companies only want to buy policies on terminally ill, old people. So can we demystify that? And somebody had mentioned on your website, it said that you only buy policies on folks that are like 60 years old. So can we just talk about those two myths?
So great question. So the answer is, at the end of the day, go back at the beginning. In the beginning, you had to be terminally or chronically ill to sell your policy. So the medical settlements, that was the criteria. There was no other marketplace other than somebody that had a certifiable life expectancy inside of 3 or 4 years. So now, I mentioned pension funds earlier. They're going out and buying someone who's 63 years old. We'll make that example, extreme example. But their premiums are very cheap, and they're getting ready to throw the term policy in the garbage. So they say, here's, and we'll make it a $1 million policy. They'll say, here's $15,000. We'll take over your life insurance policy, because the guy's literally throwing it away. And you say, well, why would someone take $15,000 for $1 million? And I say, because he's getting ready to lapse it for zero. So 15 is better than zero any day of the week. So that's the extreme example. So you can sell your policy when you're younger and healthier, but you have to have the premiums of the match. So it's just a math game, as you were talking to before we started. It's how much do I have to pay in premium every year? What's the minimum amount, cost of insurance every year to the life expectancy, and then they will add probably 2 to 3 years on top of that, and that will be how they'll prepare their escrow going forward on that purchase.
And that makes all the sense in the world. It's just mathematics. I mean,
it's math.
It's an investment.
The law of large numbers will take place. So let's play it through. Someone will buy a policy, and you and I, Chris, are the investors. And the guy comes in, he's got a life expectancy of 10 years. And we both agree, that's a 10-year LE if I've ever seen one, and we buy the deal. He will live to be 25 years. He'll live 15 years past his LA. And then you'll get another one that's got a 16-year LE, and you go, that's about right. And the client's pretty healthy, but the premiums are cheap. We're going to buy that policy at that number, and they'll die because they'll learn about pickleball at Hilton Head next winter, and they'll die of a heart attack on the court. It just happens. So the bell curve that we've all seen our whole lives, that's the LE. It's not like, what's the LE on John Stevens? Oh, he's got 84 months, and they put that dot on no, the whole line is his LE. That's where we think most of the 100 of him will die, but they will go past and forward. So yes, it's that part of it sometimes people want to think like, well, that's kind of, ghoulish. And I go, okay, so is life insurance in general, because that's how it's priced. They figure your age, your health, generalistic, there's all these models that come up with what they think the cost of insurance should be based upon you at this rating, whether you went under a health examination or not. So it's confusing, but the answer is you don't have to be sick to sell your life insurance policy. There's many stories of people that use their proceeds upon retirement and open a business. It is their money. They can do whatever they want. There are no restrictions. And they certainly don't have to have a terminal illness, and they can, like I said, you can be 40 and sell your life insurance policy. Unfortunately, you're going to have a large health issue if you're able to sell your policy and you're 40 years old.
So Andy in the chat went to the website, lisettlements.com, and he just kind of did like a rough, it looks like he just put some info in. It said, we're sorry, it does not look like you're over the age to qualify at this time. You must be over 60. So would it be something you would broker out, or like,
well, no, we would broker that. Did he go on my site? Because I don't think we have a calculator for that very reason.
I don't know. It's lisettlements.com.
Did he send it? I have to look at that, because we very rarely, if you're 58 and you do be a health questionnaire, what's your overall health? So if you say you're 58 and you're healthy, generally not going to work, because it's just going to be, the math is going to be too long. You're going to say what's your standard health, and your life expectancy is probably going to be 30 years, and nobody's going to buy that.
Yeah,
I wouldn't have to broker that. There'd be no buyers.
Yeah. So on a policy like that, that's why we have multiple sources. So we've got another company that would buy it just for the cash value component, because they basically use that cash value to support and to guarantee a backed, we won't get into the coin. So there's different uses. It's just want to make sure everybody on here knows like what the threshold is. And with that, I want to go into the next one. When people are thinking about this, like from your standpoint, you've been doing this a long time, like what is the number one reason people sell their policies, and what are the most common reasons that people would even explore selling their policy versus maintaining it or surrendering it?
So today it's unaffordability. They can't afford it. I mean, COVID, your earlier discussion talk about COVID. COVID taught us that life insurance on the roster of things that you pay for on a monthly basis is in the category of a luxury. You know, you're going to pay for your home, your mortgage, your rent, your electricity, your gasoline, your car, your food, your medicine, all of that, and your insurances to keep those, maintain the house and the car, et cetera. And the life insurance policy shows up, and they're at the end of that. So we saw a big increase of people dumping policies who were lucky enough to find out they could do that for money, as opposed to letting them lapse. A lot of them were term policies in those scenarios. So that's really what I would highlight to end that. I mean, I don't think there's a reason why there's an absolute solid reason. Some people just don't want the life insurance policy anymore. They might actually need it. They don't want it. They want an annuity. They don't have the money to pay for that. And the clients, the agents, like, will sell the policy, and we do that. They dump it in plus some extra money. They do that. But to sit here like the snowflake, they're all different. I had people to buy cars, go on vacation. Got one of my earlier clients called me up 3:30 in the morning. He's a lawyer in California, and said he had brain cancer. This is in '96, and he needed the money to go to Europe to get cured. And I said, okay. So we got him an offer, because he was, by everybody's mind, including UCLA Medical Center, where he was being treated in the oncology department, that we are out of options. You need to get your affairs in order. So he sells his policy, and 3 months later calls me back. And he said, I just got back from UCLA Medical Center to show my result. He had completely cured his brain cancer.
Wow.
Someone created
What an awesome
with the
story.
money he did. Now, the investor in that case, let's be honest, that was not a good investment for him, because, you know, this particular gentleman lived a lot longer than anyone anticipated. He was older, but he had money, and he used it for what he wanted to use it for. So there's really no cookie cutter answer. Right now, unfortunately, it's unaffordability. I think that everybody just thinks everything's too expensive. Everything is too expensive, and they just get to the point where they just can't take it anymore. Premiums that were once X are now X plus Y. They're not going to do it anymore.
And, you know, Nick, it's kind of funny, like with our audience, you know, you got Nick, he's like, why would anyone get rid of their policy? But, you know, Nick's been around the campfire a little bit, so he's just like, that would be the dumbest thing ever. But believe me, Nick, and anyone else is wondering that, there are people. And you know, we've seen it since the economy has weakened. So, you know, you all know there's a major debt problem in this country and people are getting pinched. We've seen surrender requests go up on our end, not tremendously, but we've seen more and more of them. We're doing a good job of talking people because our policies have lots of flexibility built in. You know, the premium isn't the amount they have to pay. There's minimum that they can reach. So there's a lot of flexibility, but there is that odd case where the person, you know, like I mentioned earlier, so if any of you are coming into this webinar a little late, you missed that, where I'm like, people just throw their arms up, either they're embarrassed or, you know, something, and they just don't want to hear options. They just think this has got to go. I don't know what else to do. Divorce is another reason. You know, we see a lot of surrender requests when people are getting divorced. You know, it's just like they are just trying to thin everything out. They don't care. They just want it gone. So it does happen. And this, you know, is just an option so that everybody on here knows, like, if that ever happened, we've got another option for you. So Rob, I don't know how real this could be, but I kind of had a little idea, because one of the things I wanted to know is how does a life settlement work? Like, who qualifies? Like, what is the process like, and how do you determine the value? So I don't know. I'm just going to spitball, but let's just say somebody owned this policy right here, and they bought it when they were 55. Let's just fast forward. They're 6 years in. Now they're 61 years old. You know, they're diabetic now. And, you know, here are the numbers for the policy. The premium's $11,000, minimum's $5,500. And, you know, I don't know if you guys use the guarantees, you know, in whole life, because this is a whole life. And I know you said,
Yeah, I'm looking at it. So that would be 61 and healthy. So just the reason why whole lives are not bought with a great amount of regularity, because people don't get rid of them as frequently as everyone else, just for whatever reason. I think you probably know the reason better than anybody.
Well,
So
because they're
61 years
guaranteed.
old, premiums are cheap, right?
Yeah. So you guys would be looking at this premium, right? Because you're more focused on, like,
future.
you're looking at the death benefit.
Yeah. What's the death benefit, and how do we, so they're always wanting to keep the death benefit. No one wants to buy a decreasing death benefit.
Right.
They want to turn that into a level death benefit with the minimum cost of insurance going forward. So a level premium to maturity, usually to age 100. Now policies run to age 120. And I just saw 130 the other day. But it's all just a function. It's just a function of math, right? How long is this person going to live? So what happens in this case is, let's just say I said that looks like a good case. I'm just going to play it through. If they absolutely want to sell, we'd sell them not to, but if they just wanted to, we would go out to different provider companies, and they would all do independent life health underwriting. They would buy life expectancies, and those life expectancies will fluctuate. One may come back and say 15 years, one may say 18, 19, 20, 21. And then a seventh will come in and say 12. And that person might be, that provider might be one of those groups, that funding entities that says, I only buy off of that one LE. I'm going to make a bid on this. And you might get a bid on that case because it's so, in their mind's eye, they think this is a 12-year life expectancy.
Okay.
So then you come back with an offer. Then it's up to you and your client to determine, is that a good enough offer to let go of this policy or not? You know, your earlier question was, why would someone start a life insurance policy? You gave a NVIDIA example, right? Panic. That's why that person sold their policy, sold their NVIDIA stock. And then the guy who bought it was optimistic and he bought it. So that's what happens in a lot of these decisions making when it comes to life settlements, is they're panicked. They're freaking out. They want money. They want out of this. And it's just a peace of mind, so to speak, that they buy life insurance when they're 30, 35, 40. And when they're being sold that life insurance, they're buying it because they're newly married. They just got a mortgage. They have children. They want to pay for college. All these different reasons, these boxes get checked. And the life insurance policy solves all those problems, provided you can afford it. But then when you're 30 years later, the house is paid for, you've retired, your kids have gone off, they're successful on their own account, and you're just sick of paying the premium payment. That's why people get rid of it. That's the simplest way answer for you.
So how would you price something like this? Like if somebody was 61 at the time they came to you and this was their policy, or actually let's go 65 too, because that gets them down after the term falls off, because this is the term insurance falling off the policy.
Mhm.
You know, they're 65, $5,500 in premium, their cash value, let's say they've never used any of their cash values, 249. So they could go to the insurance company and this is what they're going to get,
Correct. So
249.
that's right. That's their life settlement offer. So we are now trying to beat a $250,000 offer. So unless their life expectancy at age 65, well, it's 60, 61, is significantly, what would the death benefit be at this point in time?
431,000.
That's a 50% offer. They're going to need to have a shit ton of health problems. Sorry for cursing. Which
okay.
probably they don't have. So that's not going to work. That
Would
again, like whole life builds cash. Cash is in essence a life settlement offer.
Right.
As long as you don't use it. If you use it, which is fine, you can, then you have a chance to sell a policy, provided you're a lot older and your death benefit isn't a percentage of, because what they're going to do
So
is
let's say they had already taken loans, like this is zero. They've taken all loans out. Would that change the
no,
way
because there's a loan.
Okay, so you
We
look
pay
at
the
the loan the
loan.
same way. Okay.
The loan's going to still remain there. Perfect world is, this policy is going to be much older. The good news is, and this is for all the folks at home, I don't price deals because I don't, because they're all different, right? They're all snowflakes. They all have different IRRs. They're using different calculations. They're using different premiums. They're going in, for example, when you pay a life insurance premium, as you mentioned, here's the premium the carrier wants you to pay, but you can actually pay a lot less. That's what they do when they buy the policy. They pay the minimum. That's why life insurance carriers hate life insurance investors, because they just pay the bare bones minimum to keep the death benefit level. So all that extra money they're not getting it anymore. So we tell the client person's going to the surrender amount will always be the best offer most of the time in a whole life scenario on a younger person, in my opinion, provided there's significant cash, they haven't taken a loan out. But the loans are no different than the cash.
Hey,
in the eyes of
Rob,
investors.
what type of tax considerations would a policyholder have if they were to sell the policy?
Another great question. So if you have a terminal or chronic illness, so a life expectancy of 24 to 36 months in that vicinity, you will pay no taxes. Okay. If you surrender the policy, forget me. If you just surrender the policy, your basis up to basis, no taxes, and the difference between the basis and the surrender amount, you will pay ordinary income on all day, every day. The amount over surrender, you'll pay long-term capital gains, because we do not buy policies that are less than 2 years old. So you'll be invested inside that for 2 years. So now I'll give you another stat off the record, but also on the record. I've been doing this for 31 years. I've done probably over 40-some thousand individual transactions. And you were to put me in a polygraph situation, say, how many of your clients have ever been audited by the IRS for their proceeds from a settlement? And I said anything other than zero, the bell would go off. I don't know. So the answer is be honest about it. But at the end of the day, I just don't think that's something the IRS is chasing people for. Here's a COVID story. We had a bill called the Senior Health Planning Account Bill in front of Congress with bipartisan support, ready to go to the floor, which was going to allow people to put money inside of the senior health planning account, regardless of who they were, how old they were, how much it was, and you only use that money, those proceeds, for healthcare related activities, and it would be tax-free. It would be incredible for seniors, and it would have been wonderful for the life insurance settlement industry. But then COVID hit and nothing happened. So we're bringing it back this year. We're going to at least try, because it's something that people are been clamoring for. The question you asked, Craig, is a question we get asked all the time. We definitely think you have some tax liability when you make a profit on anything, and you should talk to your tax advisor and get his prudent advice for you.
Awesome. Sorry, getting a bunch of good questions coming in. So basically, at the end of the day, this is just another alternative for people. If they have a policy, they're pinched, they no longer need it or want it, or know somebody. I'll even kind of open it up again, or know somebody in this case, because that's you. I think our audience, like I'm just reading the comments, most of them are using this for infinite banking. Rarely are they going to surrender their policies, but they know somebody who has these other policies. I literally went back. I can't do it, but I wanted to. I went back and looked up like all the emails for people that have sent me their IUL illustrations because they thought it was one thing and it's not. And I was going to pull one up, but again, just for privacy, I just decided not to. But like that's where this could be a good fit. There's just lots and lots of those out there. Universal life, VUL, IULs. And you mentioned term insurance. Is it only convertible term?
No, they could be term as long as there's it's a shorter time frame in terms of life expectancy, because they'll, once you know about term, you don't convert them, they'll go up it's like a vertical line straight in the air of what they'll charge you till they basically, you're all of a sudden you're paying more than you paid for the death benefit. But here's the thing. I mean, I'll just say this is a compliment to you, the three of you here that I'm looking at on the screen. You have a very good show that's educating people at an important time in their lives. And to your point about knowing people, you've bought a better policy. As they're going out and explaining to people that there's a better policy they can buy, they're going to unearth these other policies. It's just natural. Wait a minute, I've got this. My agent said it's the greatest thing in the world. It's an IUL. And they say, well, Chris says that's a piece of shit. And at the end of the day, that's where, this is where the organic discussions are the best. They really are, because people just don't know half the time what they're talking about. They really don't. And that includes me. Sometimes I see illustrations show up on my desk at least once a week where I look at it and go, what is this? I don't even know what this even is. And they're like, who sold you that? How did you buy that? And they told, it's a huge dump in and I'm going to never pay another premium again. I said, well, this is a premium and you have to pay it or your policy goes away. There's not a huge dump in where there's no premiums. You have to pay. And he goes, well, I'm going to use the cash. I said, okay, well, that defeats the purpose of what you're trying to do. But in essence, that's what they get sold. So to your point, resource, we are just here to help. We may not be able to help you, but we're going to give you the peace of mind that you don't have to wake up one day and think, boy, I should have sold my policy and never asked, and find out you couldn't sell your policy and you did.
Good stuff. So we've got, Pamela's looking to, maybe set up a call just so you could review her stuff. What would be the process? Like, how would people set up a call with you to discuss this?
She can email me at rob@lisettlements.com, or she can call my cell, which I've just turned off twice during this production, at 954-599-4433, and just leave me a message if I don't answer, and I'll call you right back as soon as I conclude the call I'm on.
Perfect. So hopefully I typed that out. I was doing it as you were talking, but yeah, got that right.
Settlements, at the end of the NT, it's NTS, settlements, LI settlements.
Sorry, LI settlements. Got it. And so Pamela, add an S to settlements. I'm just going to put it up in the chat. So there we go. All right, perfect. Well, Rob, thank you so much for your time. Appreciate you kind of opening this new door for, folks. Or people that they know that might kind of be against the wall, not know what to do. And this gives them an option. So appreciate you coming on and sharing your story. Keep doing the good work.
Thank you. You do the same, guys.
We will.
Thanks, Rob.
Bye-bye.
Breaking news, this just in. Are you sick of having your money lying around not doing anything? Well, we've got the solution for you. PrivateMoneyClub.com. Back to you, Chris. Awesome. So let me ask everybody on here real quick. Now that you just kind of heard that, we're always just trying to open up new things so that everybody can, learn more, understand more, and also know all of your options. But I just got to ask everybody on here, like if you could no longer afford your policy, what would you do? Put it in the chat. If you could no longer afford your policy anymore, what would you do? Just curious, like what are the first things that come to people's minds? I love Nick. Find a deal. I love it. But realistically, like you no longer can afford your premiums, and even at the base, like we built this policy. It was $10,000 a year, and your minimum is $4,000 a year. Hypothetically, that's the amount you got to pay to keep the policy in force. You can't do $4,000 for some reason. What would you do? What would be the first thing you would do if that was the situation? Love that. Lisa said, borrow from my son. call the TMM agent, explore the alternatives. And there are lots of alternatives. And we've created a whole bunch of videos showing all those alternatives. There's tons of them. People don't even know this. I mean, you could RPU your policy and you'd have no more premiums. Like, yes, you'd lose death benefit, but your policy would have no more. You could reduce PUAs. You could use dividends to offset. Now, again, I'm speaking only to the whole life policies that we create, these specially designed and engineers. This does not, those things I'm saying, most of them do not work with the other products out there. But make a deal with the agent, or made a deal with the agency. Let's see, pull investors together to keep it together. Okay, because that would be something I would look at. I know these numbers, and I put those numbers up. I would literally go and find somebody that would lend me money to keep my policy alive, because at a certain point in time in all the policy is going to produce more than what you put in. So you put the money in, you take the loan off or out and pay the people off. That would keep the policy alive. But it's just good. And I'm just trying to kind of openly ask this question, just because I'm trying to think of how much more do we need to educate on this? How much more do we need to teach that there are options? Because it does bother us tremendously when a client calls us or sends in, and they never really call us. Like, it's weird. I love the person that said, call my TMM agent. I love that. But most people don't. They call the insurance company. They avoid us because they think for some reason now all of a sudden we're the bad guys, or I don't know, maybe they're just embarrassed. And they say, I need to surrender it. We get a notification because the insurance company won't surrender the policy without notifying us first. We try to call the client. If we get the client on the phone, we usually can solve the problem. But a lot of times the client just won't get on the phone. And that's like the worst day. Like, when I get those emails and those notifications that a policy lapsed, that is a terrible, terrible day for me. Not because I lose a client. I mean, with tens of thousands of clients, not saying that in a bad way, but it's because I know what that person just lost. I know what that person gave up. And that is where it becomes really hard. And we will try in any which way to try to explain that. Now, I want to kind of turn this over to Stephen for a second, because I think just when you're thinking about life settlement and you're thinking about it, it's a last resort option, but it's really not. And I think that's what Rob did a good job, is sometimes it's actually part of a strategic financial strategy. So it's not just last resort. It's sometimes part of a bigger plan, a bigger financial strategy that the client might have. So Stephen, what is your take on this?
I mean, that's a loaded question.
Well said.
Yeah, I mean, I don't know what to add on to that.
Chris, I'll throw something out there. I think it comes down to one of the things Rob mentioned is this is an asset. It's like your house. Your house could be an asset. Some people say it's a liability, but it's something you can sell. It's something you can transfer. So you have options with this, and that life settlements is an option. Using dividends to pay your premiums is an option. You can sell it to somebody else. It's an option. So when people realize you have this asset, and if you can't afford it anymore, you just need to come up with the best way to exit. And that could be a life settlement. That could be selling it to someone else. That could be, using dividends to pay your premium. So to me, it's just having options.
I love it. Well, Craig, I know before we kicked off for Wealth Webinar, you created something really cool. And I wanted to, since we have some time, how many of you want to see something really interesting that Craig put together for this Wealth Webinar? We didn't know if we were going to get to it, so we kind of had it on the back end. But for those of you that are still here, which most everybody still is, I think you're going to really love this. Craig, why don't we show them what you came up with on the retirement forefront?
Yeah, and one of the options that we talk about is when you have cash value, just like that sheet you pulled up, Chris, you were showing, I think it had around $1 million or something around 65 or maybe later, but can we use our cash value for retirement funds, right?
There it is.
So if we look at 60, well, I guess it was down from
yeah, that was in 60. So this is a relatively smaller policy. Yeah, it's got a dump in, but very low premium.
Yeah. So the question is, if you got to 65, you got to 55, could you use this cash value as a retirement income supplement? Could you use it as, we've had some other wealth webinars, Chris, where I really love this one when you went over what's called the volatility buffer. And imagine if you have your stock accounts, your 401ks, your TSP, whatever it might be. And when the market's down, you could use your whole life policy as another place to go pull money instead of taking it from your accounts when the market's down. So a lot of the stuff that we wanted to go over today is just showing you an example of how you can use your policy for retirement income. So I'm going to go ahead and share out some
I'll give you
slides here because everything I do
Yep.
is in slides.
And one other thing, that just came through, I think it was Nick that said it. This is pretty interesting. Like, how many of you have ever, been out, you're getting a little older. I'm 47 now, and you're out doing the sport you love or the thing you love, and you just get that hair up your ass, and you just like, I'm just going to go a little faster. I'm going to go a little higher. I'm going to do a little something crazy. Like, how many of you ever, like, because you got the life insurance in place, and you're just like, you know what? My life insurance is paid in, like, it's all paid up. It's in force, got lots of money. I'm just going to go for it. Anyway, maybe it's just me and Nick thinking that way, but I think that way a little too much, which resulted in not broken, but bruised ribs this past weekend. But anyway, how many of you, have that extra boost of confidence just because your life insurance is in force? Maybe we're the only ones, Nick. But anyway, go ahead, Craig. I was just.
It makes me feel more comfortable when I'm doing stupid things, but it's it's just part of the lifestyle, I guess. So one of the things that I like to start off with is just whether you understand all these pieces and parts. It's almost like all the ingredients that went into the design of the policy. So imagine if you had a policy with a one-time $50,000 dump in, and then every year you're going to put in $25,000. And we'll split that up into the correct PUA and paid up additions, which is the cash component of the policy, and then the appropriate part of the base. But really what we were doing is kind of running this case study is, what if you were to have this policy, but you're planning to retire at 55 and you need some sort of income gap to get you to the 65 or even later when you have your retirement funds available. So we designed a policy to do such a thing where there's a $50,000 dump in. So that's why you've got the 75,000 here, and then 25,000 every year. And then at some point, that term policy the term rider inside of the policy drops off. And the reason it was there is to prevent the IRS from taxing our growth. And Chris, I know there were some questions earlier on about loans and are those taxable? So if you were to take a loan from the policy, would it be taxable? The answer is no. And I think you had asked someone if they were from Canada, because I think there's some different rules up there. Is that correct?
That is correct.
Yeah. But generally speaking, when we're doing infinite banking and you're taking loans from your cash value, those are not going to be taxable if your policy is not a modified endowment contract, or you've stayed underneath that line anyway. So here we have a policy with the funding. We oftentimes look at the efficiency of the policy. And if you've been following this for a while, you're around the campfire, we call this the money tree. And so at year 4, we have what's called a money tree. What we mean by that is because of all the previous years of compounding, in year 4, when we put in 25,000, our policy grew 26,409. So what a beautiful point in the life of the policy, because now we're getting $1.05 back for every dollar we put into the policy. And I like what Nick was saying in the comments is, hey, if I ever run into troubles with my policy, I'm just going to go find another deal to take the cash value and loan it, and then I can use that to pay the premiums. So there's a lot of cool things you can do with this cash value, but in this case, I just want to call out that this particular policy has a money tree at year 4, meaning for every dollar you put in a premium, you're getting more back in growth that year. But the really cool thing about this is we're trying to come up with a strategy for that retirement income and that gap. So I'm going to draw your attention down here to the very bottom at year 25. The person is now 55 years old. And look at that. They have a little over $1 million in cash value. All right. So we're going to do a quick quiz, and just to see if everyone's listening, why is the premium 75,000 in year 1 and it's 25,000 in years 2 and beyond? Can anyone tell me? Just making sure everyone's listening. I'm watching the comments. We got a dump in from, yep. All right, so you're all listening. So we have the dump in, and that's why we had a bigger chunk of money going in there. And then we know that the death benefit's dropping at year 8 because of the terms dropping off. So that's kind of what's going on there. But anyway, let's move on. And one of the things, and Rob, you said this earlier, policies used to endow at, I think it was around age 100, meaning the insurance companies were thinking, not many people are going to live past 100, so we'll just end the policy at that point. If you're still alive, they would just pay out the death benefit. So let's say that you had a policy that endowed at age 100 and you were still alive, they would pay out this death benefit to you. Because of longevity, a lot of these policies now are endowing at age 121. So now we as humans, we have to just keep taking care of ourselves and maybe keep pushing the endowment age out. I hope I see that 120, but we'll see what happens. All right. So what we're going to do is we're going to talk about different ways to get cash value income from these different policies. So option one would be you can take a withdrawal of the cash value up to the cost basis. So what do we mean by the cost basis? And I'm just going to go back here real quick. And if from year 1 to year 25, we put in all these premiums, that adds up to $657,000. Okay. So that means you've put in $657,000. That's your cost basis. So what you could do is take out enough money throughout time where you've used up that 675,000, and then we would switch to a loan strategy. So that's one way to get income out of your policy. If there's any questions, go ahead and put them in the Q&A too. I'm trying to make sure I don't go too fast on this. The second option is instead of doing withdraw at that age 55 or that retirement, you could just start taking loans, just like you've been doing for when you buy cars or when you do investments. We just use loans. We don't take withdrawals. So that would be another option for you. Now, here's the cool thing about it. The insurance company in their software, if you were to say, hey, Craig, I've got this policy and I'm now at retirement age, what's better, take withdrawals to cost basis and then switch to loans or to use loans? We can just run the numbers and we can see how that plays out based on the projected dividends. So you don't have to make a decision, meaning if you started a policy with us today or you had a policy, you don't have to make this decision now. You can make that decision when you get to the retirement age. As I had mentioned, if you have $657,000 of premium deposits over your lifetime, that means you can withdraw up to $657,000 without any tax consequences. The next dollar that you pull out, though, if you were to do withdraw, would be taxable. Loans are not taxable, but we do have to consider if we're going to be taking loans for 30, 40 years and not paying them back because we're using this for retirement, we have to realize that there's an interest charge in there and that will compound on us. We just have to make sure the math works. But one good thing about cash value life insurance, the income that we're getting from that, whether we're doing withdrawals to cost basis and then loans or doing loans, when you have money coming from your policy, it doesn't count towards your taxable income that would impact your Social Security. So isn't it funny that we pay into this Social Security system for years and then we get taxed on it if we make too much money? It just sounds like a complete scam. But anyway, that's the way it works. So the good thing is cash value, the life insurance money coming from the cash value is not going to, put you in a taxable situation alone just based on those numbers. All right. One thing I do want to mention is in this case study, let's say the person was 30 years old when they started their policy, and maybe they're building it for retirement. Maybe they want to have this cash value for the retirement years. It doesn't mean that throughout your lifetime, you can't use it to get rid of third-party debts. So if you have third-party debts and you have a policy, what a great way to get rid of your debts. If you're going to go buy a car or go on a vacation, or maybe you have college for your children, you can use your cash value to finance those major purchases and then pay it back. Those are all the things that we teach all the time. It can also be a great emergency fund storage. So the whole point is all of this stuff I'm talking about, we're going to use our cash value for retirement. But while we're building and working and going through that accumulation phase in our life, why not use that cash value to kind of do those banking functions? So we're going to move on. And for anybody that's new, if you are new, if you're working with our team, and Stephen, if you want, you could put the link in. But if you're someone that has debts, we can show you the strategy of how to pay down your specific third-party debts with policies. We can show you how to invest. And Nick was talking earlier about how he takes his cash value. He's got an awesome deal he's putting his money into to compound it and make more. So we have some different models that show you how to pay down your debt, how to invest, how to buy major purchases, whether you're looking to buy cars, college, vacations, it doesn't matter. All right, so let's get to the fun part here. We're now this person started at age 30, now they're 55, it's time to retire. the big question is they call up Chris or they call up Steven or myself, say, hey, I've got $1 million of cash value. I want to retire. Should I start taking loans or should I take withdrawals to cost basis and then loans? Well, we ran some numbers. So here we are with using the calculations from the insurance company. I just said, I want to be able to take the maximum amount of retirement income from this money over a 40-year period. And just to keep all the apples to apples, I said at the very end of the policy, so at age 121, I want to have $100,000 left over. So that this 20,000 number could be bigger if you wanted to, shorten up the number of years you're taking income. It's just kind of a game of how long do you think you're going to want to take this income. But regardless, the calculation came back that I can take $20,384 of income from this policy as a loan every year for 40 years, starting at age, say 56 to 95. And what I want you to kind of see is the loan balance column just continues to creep up. And so at the end of that 40 years, we have a loan balance of 2.9 million. The other thing I want you to kind of look at is this dividend. Look how the dividend continues to grow. And at age 95, we're cranking out $150,000 dividend every year. Oops. And so if this person were to do this strategy and they graduated or passed away at age 95, they're going to pass on $2.6 million of death benefit to their family. Okay. Now, if you were to take this death benefit plus the loan, that's going to be that 5.5 to 6 million, somewhere in that ballpark. But that's what the death benefit would be if you didn't have an outstanding loan. And this is the thing. This is why the insurance companies don't really care if you pay this back. They know they're getting paid back at the end. So insurance company keeps the 2.9 of your death benefit and pays out the other 2.6. All right. So that's just taking loans. That's kind of what life looks like. And like I said, at age 121, you see how the cash value is 100,000. That's just because I said that's how I want to end up with the policy. I want to have at least 100,000 left. And the reason we went from, you might be saying, well, gosh, Craig, you still have, 2 million of cash value here. Why not take more out earlier? It's because over time, this loan's going to keep getting bigger and bigger and bigger. And eventually at the end, it's almost 11 million. So it's a pretty sizable loan, which means because that loan just kept on growing until we're age 121, we now have 100,000 left over. All right. So I'm just going to stop there. Chris, have you seen any questions, anything we need to address yet?
Coming in, I mean, this is interesting because I'm going to spin this thing at the end when we're done with these two examples. But in this case, I mean, did you just roll the loan interest back into the policy every year?
Yep. Just kept on rolling the loan interest, never paying it.
So I want to make that clear that, this is someone who clearly hasn't been around this campfire, that, went to the other side of the street and went to their advisor, took out a whole life policy, built it like this, and just ran this thing straight down, because we would never, ever do it this way. But nonetheless, this has all the interest on the loan just rolled back into it, which drastically hurts the amount of money they can take.
Yeah. So, and it just, it's just kind of showing how the math works out if you were to take that approach. The second approach would be to take withdrawals to cost basis. And then once you've hit that cost basis mark, we're going to start taking loans. Well, we can take 36,491 out as opposed to the 20. So this does allow you to take more out on a year-by-year basis. And you'll see there is no loan balance until some point in the future when we start taking loans. So at age 95, we do have a loan of 1.5 million as opposed to that 2.6 or 2.7, whatever it was. But do you remember, does anybody remember what that dividend was when we were just taking loans? Because now it's 80,000. It was about 150. So by taking withdrawals, we're kind of hurting the growth and that building up of the dividend and the cash value, but we are able to take more out. So it's just one of those things when you get to retirement age, if you're going to do this strategy, we just have to kind of weigh out what makes most sense for you. But if I draw this out and I go down to age 121, we still end up with $100,000. We had a lot less in loan balance growing, but we still ended up with 100,000. So hopefully this kind of helped just to show the differences between taking loans only and using income, or taking withdraw to cost basis and then using loans. Those are the two main ways you can use the cash value as an income stream.
And, when I was an advisor, like we did this strategy quite often. I mean, we would often do it with VULs just because back then that was the flavor of the week that we were told to sell. And that's kind of how it worked out. When I was at New York Life and kind of, coming up through the ranks there before I became, part of the RIA, basically this is the strategy that they taught us. Like, this is what we did. We built whole life or VULs, or gosh, even those old ULs, and we would take withdrawals up to basis and then loans after that to avoid paying taxes. But the way we do it really doesn't, Craig just showed those examples, but just imagine, and Craig, I might ask you to pull those numbers up again. Just imagine if instead of just taking income out of your policy every single year, imagine if you took a loan from the policy, in those earlier years. So forget about the retirement years, in the earlier years, and you paid all your debt off. And now you didn't have any debt payments on anything, and you just used those debt payments as extra income and invested that or put that into additional policies. And imagine if you never bought a car the traditional way, and you bought cars through your policy, but recaptured and recycled all the car payments that you're giving away to the bank. So none of the interest right now none of the interest you would normally give away to the banks is being given away. It's all being paid back to yourself. And then imagine you do that with college, and you do that with all the things for your kids, so that by the time you hit 55, where Craig was showing taking the loans, how much more money would you have accumulated? Significantly more. I mean, like, I don't even know, but it would be significantly more than what he showed. But then just imagine, Craig, can you pull the number up again? Just on, it doesn't matter, either one of those. Instead of just taking loans or income out of the policy, imagine if you took a loan from the policy and you did something like Private Money Club, and you became the bank, and you were lending on a really conservative, safe, private loans and first lien position with personal guarantees, and you started making 12%. What would that mean? And I'm not saying this is appropriate for every single person, but I'm just kind of showing you that it's not the policy. And we always say this, it's not the policy that's going to make you wealthy. I mean, yeah, maybe this is better than some of the other alternatives. You don't have to wait till 59 and a half to be able to take retirement income. You could supplemental retirement, like from 50 to 60, that you couldn't do with your 401k or retirement plan. But when you add the process, the infinite banking process, the banking function to this, it changes the game. So let's go to 55. What was the cash value at 55?
So at 55, we had 1.1 million.
All right, so we'll just do 1.1 million. Now, let's just say, I'm just going to hypothetically say we lent that out. Right now, the lowest, I don't even think there's 12% deals on Private Money Club, but let's just say it was 12. That's $132,000 a year right there. Now, there's some risk with that. So there's no risk with taking loans from the policy, but lending money out on a deal does involve risk. So now you're entering that risk in, but arguably, and I think you could just look at the institutions like pensions or insurance companies and endowments, like they're doing a lot of lending in first lien position from those. So it's obviously a more conservative approach than going out and dumping the money in NVIDIA or S&P 500. But that's 132,000. I mean, what would it be at 15? I mean, these are just deals he's just going on and just pulling up. So at 15, you're at $165,000 a year. So again, just throwing different options. I mean, and we're only using just the money from the policy. We're not factoring in anything you would have made from the banking aspects of what you'd be doing with the policy's cash value in those early years as you're accumulating. But even then, there's just better alternatives. There really, really are just so many different alternatives. And I want to go back to one thing, Craig, that Rob said earlier. He had mentioned pension plans. Now, you all maybe know what a pension is or don't. I mean, they're kind of a dying thing these days, but some folks actually get a payment every single month from the company that they worked for 20 or 30 years. Like, imagine that. Yeah, some people actually just get a check from their employer because they had a defined benefit pension. They're not common, but those pensions have to earn money. Those pensions are out there having to make money, to build that money so they can provide that pension payment to all their people that put into the system. And Rob said, what are those pension plans looking for? Life insurance policies. They want to buy your life insurance policies. What are banks doing with their tier one capital besides treasury bonds? Buying life insurance, So we could just go down the road, and you could look at all these people. I mean, when we're talking about 3 feet from gold, and I apologize, that example, insurance. It always ends up back at the same place, and the same place is the place you've been told not to put your money. So it's just kind of funny that all those institutions see the value in this, but a lot of the advisors out there, a lot of the gurus out there like Dave Ramsey, they tell you not to do this. It just makes you think. And I'm just trying to get you to start thinking about what's really going on out there. So key takeaway, Craig, anything else on the retirement stuff?
If you think it makes sense, we can run through the kind of the flow of the money, or we can table that for another day. But
Well, just, yeah, show them the flow, because I think there's some people here that would probably like to see that. And then I don't really have much left besides I just want to hit some key takeaways. And if anyone wants to book a call with one of our mentors, Stephen put that link up there. You just book that or click that link and book a call. But yeah, go ahead, Craig, show them the process and how this would work.
yeah, so I think this is yet another option. So we talked about using cash value and just taking withdrawals to cost basis or loans out of the policy and just kind of using the policy in an isolated fashion. What we're talking about here is, if you were to take the cash value and the numbers don't really matter for this example, because you might have 500,000, you might have $1 million, you might have 50,000. If you understand kind of how the process of how the money's flowing, this is kind of what we do when we invest with the cash value. So for example, let's say in year one, you do $100,000 dump in, and then every year we're going to put in 12,000 in premium. What that would allow us to do is we'd put that 112 in, we'd have a loan balance of 93,308. And we're going to put that into an investment that like and understand. In our example, we're assuming we're putting it into a lending deal. A lot of us work within the private money club to do lending. So I would take that 93,000 and I would lend it to somebody in a first lien position. So I'm protecting myself with collateral. They will pay me 12% yearly investment return, and they'll just pay out monthly. So at the end of the year, I would have accumulated 11,165 of gains. Of that gain, some of it I'm going to keep either for living, for retirement, could be for a reinvestment. Maybe I put it all back into the policy. But at the worst case, we may just take some of that and just pay loan interest and keep running this money through the cycle. So then next year we put in another 12, we add to our capital, maybe we pull out 10, we put that to work, and now we've got over 100,000 working, generating more gains. And we just keep doing it year after year after year after year. And I'll just jump down to kind of what it looks like in this example to say year 10, where by year 10, we're not putting in the full 12,000 anymore. We're now putting in something less, let's call it 10,803. Because of 10 years of doing this, we now have a loan balance of 230. But this is one of the things that's really cool is we put in 10,803, but we pulled out 18,000. And why are we able to do that? We're able to do that because every dollar we put into this policy is compounding and growing year after year after year. So it becomes a flywheel that's spinning so fast that it creates, it's the golden goose. I love how you called that earlier, Chris. This is the golden goose. This is the golden goose. Why do you want to kill the golden goose? And so we'll just keep this thing going. And now we're going to add 18,000 to this 28 that came from year 9. And we're just going to keep adding it to our capital. And so over all this time, we now have 372,000 in an investment. It's still our money. It's kicking off about $44,000 a year. We're keeping 33 and putting 11 back in as loan interest. So the whole point is it just keeps getting better and better and better every year. And the way I always look at it is how much have I put into the system? Well, 216. What do I have as the net benefit, which is my investment, my cash value that's remaining in the policy? So I've got almost a 99% cumulative return on this, and I've got a death benefit to go along to boot. So it's when we think about retirement strategies or just building cash flow, this is a really great strategy. And so we don't have to wait until retirement to do this. We can do it with our cash value now, and it just keeps getting better and better. And then you've got, your pension, you've created your own pension. So Chris, with that, I think we can wrap it up, but If there's any questions, happy to address those.
Yeah, I think we've been doing a good job of hitting the questions. And again, if anyone wants to book a call with Rob, we just put his number up there. I also answered a few questions. And also, if you want to book a call with our team to talk about how we can help you solve your needs and goals, whatever they are, with teaching you how to be the bank, we're happy to do that. But just key takeaways, I think one of the big things that, really stood out, when Rob was talking is that life insurance is an asset. When you look at life insurance as an expense, like the CPA said they did, and that's a crying shame that a CPA looks at life insurance, especially permanent life insurance, as an expense, because it truly is an asset. Look at any bank's balance sheet, and that's the only thing you'll ever need to understand. BOLI is life insurance, and it does not exist on the liability side. It is on the asset side. The second thing is, with life settlements, another arrow in the quiver, if I'm saying that right, they can be a really smart financial move depending on the opportunity or the circumstances that you are faced with. I loved his example of the brain tumor, I think you had mentioned, or brain cancer, where they sold their policy because at that point it was like they needed to do this surgery, but insurance probably didn't cover it. So they needed the money to do it. And well, that person very well might be living today because of that. And without selling the policy, that wouldn't have been a situation. It was just get your final affairs in order. And, we'll see you in the afterlife, and, your death benefit will pay out to your family. But the other thing too is, before letting a policy lapse, and I think this is the biggest sum up to this whole thing, before letting a policy lapse, please, please, please promise me, Craig, Rob, and Steven, that you will look at your options. Do not be, and I don't want to say this the wrong way, but don't be the coward that doesn't call us. Don't be the person that's embarrassed. Don't be the person that avoids talking to somebody about your options because of this, that, or the other thing. Pick up the phone and call us, and we will lay out your options. It is not a selfish thing. It is not a greedy thing for us. It is just, we know what these policies are. Clearly, Rob's company will buy them. That's how much they know the value of these. So don't let your asset really come back and bite you in the ass later because of selling it or not selling it or letting it lapse. And that's pretty much all I got for you. We got Ask Me Anything happy hour this afternoon at 4:30 as always. Somebody was asking about that earlier. We do it every single week. It's like the Brady Bunch. We all get together and we just answer your questions. That's happening at 4:30. If you want to join us for that, just go to my YouTube channel, subscribe, and there's a little bell up top. Click that bell and that'll notify you every time we go live for Wealth or WTF and also Ask Me Anything happy hour. With that being said, thanks everybody for joining us. It's been an honor to be here. Rob, thank you so much for coming on and sticking with us through the whole thing. I know you're out there doing the good work and saving a lot of people from lapsing their policies. Thanks, everybody.
I'll say this, Chris. I've had 2 people reach out to me in a text message fashion and another email. So that has never happened in a live show in my life. So you guys really got something good working here. So thanks for everything. I really appreciate it.
Absolutely. Those people probably have IULs, but hopefully whatever it is they have, hopefully you can help them out, Rob. Appreciate that very much. And with that being said, thanks everybody. We'll see you at 4:30 on Ask Me Anything. All right. So I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.